So the fundamentals are in flux, and that creates uncertainty and that creates volatility. We were not that many weeks ago in an environment where earnings were kind of double digit as long as you could see, and we had good PE ratios because the environment was good, inflation was low, the Fed was going to move, but just at a pace. Now, all of a sudden, rightly or wrongly, both of those are in question. On the PE side, it's now inflation, interest rates have moved up some. The Fed might go too far, and therefore PEs have to come down. And on the E side, we're having, finally, David just referenced it, a view that no, earnings aren't going to grow a double-digit percentage forever. Look, the economy is still good, but it's slowing, and how slow we're going to get is a concern, and that's the earnings concern. And meanwhile, what's going to happen with inflation and interest rates? So it's a resetting, and that creates all kinds of volatility, and volatility tends to beget volatility.
Yes, okay, can we talk about that
parity
concept,
products
Bob?
And other momentum? Sorry?
Let's talk about that concept. I want to, in the time we have, I want to dig more into what you just said, because I'd mentioned it earlier. I've mentioned it on other shows, but it's kind of gotten poo-pooed. I know Mike Sand totally disagrees. Bob Pisani has disagreed. But in January of 2016, the Dow fell, what, 20% or whatever it was in a month. In February, we saw some extreme selling. Now we're seeing this kind of crazy volatility, which has seemingly come out of nowhere. Do you believe there's anything to the theory that the market structure, the heavily weights of many of these ETFs and the biggest cap, big tech stocks, which control hundreds of ETFs, 30, 40, 50% of ETFs. Is there anything that the market structure has done which has whipped up this round of volatility?
Oh, I think so. Yes, you're touching on it, but I'd move more to the amount of money that's being managed on a momentum basis and other programs, other mechanical methods. When the market's going up, the momentum players go long, high volatility, short, low volatility, and they leverage it. And when you get a swing, you've got to reverse that quickly, and that creates the additional volatility. When you come up, the volatility goes on the downside, and vice versa. So I think they're new players in the market in a significant way. And the other structural change is not brand new, but it's been happening over time. The specialist system, which used to take the other side of the trade, is just not there. And so markets go where they're going to go much more quickly.